In this week's video, we'll review the latest charts and data to help us understand why this major shift could impact portfolio returns for decades. We'll be moving quickly, so feel free to use the pause button on your video player. You may remember in last week's video we provided a secular trend update. This bullet point here and this bullet point here will help us understand the context of the current secular trend. And then in the back half of the video, we'll talk about monitoring and navigating during a secular trend. It's a daily chart of the S&P 500 index as of the close on June 23rd. Still have the constructive convergence of trends look here with that improved look on the 250-day moving average in black, downward sloping in Q1 of this year. Now a more constructive and turning up look. As noted back on June 14th, the S&P 500 did leave a gap behind down near 4,200. It wouldn't be shocking if we move down into this area or even into this range here. If we look at the anchored volume weighted average price lines for SPY, the S&P 500 ETF, as of Friday's close, similar situation here. As long as we remain above this blue line here, really nothing that says the rally off the October low is in jeopardy in any way. So this band in here represents possible support if the market wants to come here and backtrack and retest this area. Also still have a very constructive look holding above the two lines tied to the COVID low and the COVID high. In terms of our positions, we want to ask two questions. Does the rally off the October low still look healthy? Today the answer is yes. And does the secular trend still look like it's in play? And that's something we'll cover in more detail this week. In last week's video, we talked about having realistic expectations about 100% normal and to be expected volatility that's going to occur within the context of any uptrend. In recent months, RSP, the equal weight S&P 500, has been a laggard relative to the S&P 500, and yet it still looks good. We have had some 100% normal and to be expected give back this week, but given price is above all of these anchored volume weighted average price lines, including orange and blue from the COVID low and COVID high, much like the total world stock chart, both of these charts tell us that buyers are still in control. If price were to get down into this area here or this area here, concerns would increase. In the third week of June, we're still maintaining that secular trend look with price above an upward sloping 200-week shown in red. And the trend strength model that feeds into the CCM market model has two components, both scoring between 0 and 100. One of the components has a little bit longer term focus, both of them checking 100% of the bullish boxes. And you may remember in 2022, we created that special situation supplemental tool to be used after the S&P 500 drops 20%. The tool was designed to differentiate between failed bear market rallies in 1957, 62, 66, 70, all the way out to 2020, and successful rallies when a more permanent low was in place. So the fact that we're checking roughly 98% of those boxes is a very good sign relative to odds related to October being the low. Bottom left-hand corner of the screen is a Dow Jones News article dated June 22nd. Jobless claims are just a touch above historic lows, signaling the labor market remains on solid ground. We've seen some gradual cooling, and in many ways that might be a good thing. That might allow the Fed to back off. We don't have any evidence in hand that says we have massive problems with the labor market. Still don't have any real visible cracks in the major economic data that's used to declare a U.S. recession. And if jobless claims are just a touch above historic lows, if you review these bullet points here, it's very difficult to understand where the recession comes from and where the big hit to earnings comes from. And as always, we're making comments about the data and the charts in front of us. If any of this or any of this changes in a significant manner, we'll have to reassess those probabilities. That's where maximum flexibility comes in. In last week's video, we updated the secular trend thesis in detail and made a factually based argument that the present day could be similar to August of 1956 in the context of a secular trend. Additional upside from August 1956 into this peak here was 142% in the S&P 500. And based on the data in front of us, we can make an argument that the present day, June of 2023, similar to January of 1989, also within the context of a secular trend. From January 1989 to the peak in 2000, the S&P 500 gained an additional 444%. Now we're going to talk about context. I think in last week's video we said that every day that goes by, it's looking more and more like the secular trend in stocks is alive and well. I think it's probably fair to say that every day that goes by is looking more and more like the secular downtrend in interest rates is in the process of flipping from down to up. If you know market and economic history, you know that interest rates peaked at very high levels in the early 1980s and eventually dropped down here near the COVID low to borderline ridiculous levels, with some countries adopting zero interest rate policies and even negative interest rate policies. I think you can also make an argument that this shift here really started to take place somewhere in the 2011 to 2012 window. You can almost look at this as an inverse blow-off top relative to a trend that's about to reverse. And if we look at the trend in interest rates from this point here in the early 1980s to this point down here in 2011, the trend in interest rates and price action in interest rates look significantly different in recent years relative to this period in here. And thus, given that interest rates are extremely important, probably fair to say that numerous market axioms may no longer apply walking forward. And that means we're going to have to be willing to view the markets and our approach to the markets in a different light. So from this point here in the early 1980s down to this point here, we had a secular bull market in bonds and in balanced portfolios, a portfolio composed of stocks and bonds. It's also probably fair to say if this trend is flipped, it's highly unlikely that balanced portfolios will produce the same type of satisfying returns in the future that they did from this point A to this point B down here. In fact, that might be one of the biggest understatements in the world of asset allocation. If you're experienced in the markets, there's no question that the markets have been acting differently, even in some subtle ways in this window here. And even this year, relative to Fed speak and the price action in TLT, things are different. And this is a common trait of trends. In this downtrend, this is the strongest portion of the trend here. Price stays below a downward sloping trend line. This is a little bit different look here, with interest rates poking above the long-term trend line, as well as a different look in here. All of this is foreshadowing, telling you that the strength of this downtrend is beginning to weaken over time. The trend is the strongest here in terms of the downtrend, starts to weaken a little bit in here, and then eventually looks like it's flipping. And now with the benefit of hindsight, it's easier to understand why the markets have been behaving differently, because something that's very important in the world of finance is shifting potentially. It's possible that a lot of autopilot retirement plans could produce very disappointing results in the years ahead. And even if this trend is flipped, it doesn't mean that interest rates are going to go straight up. In fact, if you look at the slope of this line here, it's highly unlikely that that slope is going to continue and we can just draw a line out here. Even if interest rates, the longer-term trend is now up, there will be counter-trend moves in periods where rates are falling, and that may even happen for years at a time. But if this trend is flipped, then the performance of bonds, especially relative to stocks, has most likely shifted in a major way. And in terms of the way markets act within the context of a bear market, this shift made traditional safe haven assets perform in unexpected ways in 2022. You can see in the dot-com bust bear market up here, The S&P 500 fell approximately 50%. In this bear market window, TLT, IEF, and gold all produced positive returns. Similar situation during the financial crisis. The S&P 500 gets whacked, bonds do extremely well, and even gold does well in this bear market. These are the point-to-point returns, the max gain between point A and point B, point A and point B, even better. TLT and IEF both up almost 40%, and here gold up 15% at the max gain level between this date and this date. Similar situation in the financial crisis. TLT absolutely crushed it. You didn't have to do anything particularly fancy. You could own boring government bonds during the financial crisis, and that would have helped performance. Gold did extremely well between this date and this date. Not the case last year. TLT and IEF lost money right out of the gate and never recovered. Gold did make some money, but most of it was made very, very early in the year. You can see point to point, gold was, for the most part, flat. And as we covered at the end of last year, a lot of assets got whacked. And a lot of defensive type game plans that were used in the past in bear markets couldn't rely on traditional safe havens because they got whacked as well. In fact, TLT lost quite a bit more than the stock market. Compare this number here to this number over here and this number over here. It's a big difference. And that contributed to our poor performance last year. How about balanced portfolios? You can make an argument that 2022 was the worst year ever for stocks and bonds. So looking at the performance of stocks and bonds going all the way back to 1871. This is 2022 down here. Probably fair to say it was an extreme outlier. It's always important for us to try to understand what happened when things don't go particularly well. That's the way we improve. We had a very uncomfortable drawdown in 2018 that we were not happy about. We added a lot of new tools to our toolkit and bounced back by producing 3 consecutive years of double-digit returns, and I am confident that we will bounce back again. Now, the reason for reviewing all of this is to try to understand the context of the current secular trend. Now, this type of outlier and this clear shift on the long-term chart of interest rates tell us it's highly unlikely that the next 40 years, relative to the last 40 years, aren't going to feature some significant differences relative to asset allocation, winners and losers. And it's not just on the chart of the 10-year yield. The longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. These are mutual funds. If you like to think in the ETF world, this is basically SPY divided by TLT. Probably fair to say this looks quite a bit different relative to this and this. And taking the time to look at things from a very high-level perspective, as we did last week and as we're doing this week, there's no question that it increases the probability that your performance is going to be better walking forward. Thus, given this, and this very long-term breakout from a 22-year consolidation box, it's probably fair to say the present-day secular bull shares more with this period in here relative to this period here. This is a secular bull market from 1982 to the year 2000 that featured a major shift in interest rates from up to down, possibly the polar opposite of what we have today. So from a fundamental perspective, this blue box from August 1956 into early 1973 probably gets the nod in terms of being more similar relative to this box here. But an uptrend is an uptrend is an uptrend, so thus this is still helpful and this is helpful. We should try to learn everything we can about price action from this point to this point and this point and this point. So let's look at interest rates from a different perspective. This is IEF. So when the price of a bond or IEF goes up, interest rates are falling. Conversely, when the price of IEF is falling, interest rates are rising. This is a monthly chart. We took it back as far as we could go. We have data going back to 2002. When IEF is above the long-term anchored volume weighted average price line, it tells us that buyers are in control. And for the most part, the trend in interest rates is down and favorable. You can see the trend in interest rates becomes so strong, the downtrend and the uptrend in IEF, that you start to drift from the line. So if we look at the same concept from different points in time, this point, this point, this point, this point, etc., all of them are telling us that we should be open to a major shift in interest rates. And a fair rebuttal might be, well, then how is it possible that we're in a secular trend if interest rates have flipped? How is it possible to think that the S&P 500 has a lot of upside in the coming years? Potentially. Thus, let's ask and answer. Can stocks rise during a secular uptrend in interest rates? We know they can rise during a secular downtrend in interest rates, 1982 to 2000. We're asked in a different manner. Are stocks doomed if interest rates rise? Well, to answer that question, let's look at a very long-term chart of interest rates. This is 1875 back here, present day on the right side of the screen. It's noteworthy that the long-term average is 4.49%. We're below the long-term average, so it's hard to make the argument that interest rates are out of control relative to how high they are. They're below the long-term average. And it's extremely noteworthy from 1950 down here into this period here, interest rates went up a lot. So keep 1950 in the back of your mind. This is 1950 in the S&P 500, and that occurs within the context of a secular uptrend in the stock market. Market does extremely well, and within the context of a strong trend between 1950 and the end of 1969. Stock market does extremely well from 1950 to the end of 1969. And in that context, interest rates were rising rapidly, telling us that the answer to this question here is yes, and the answer to this question here is no, not necessarily based on history. So we should keep an open mind about the possibility of better than expected outcomes walking forward, and the possibility that the stock market in the present day, in terms of where we are in this secular trend, is similar to August of 1956. Of course, this is an inexact science in terms of the timing on it. The key takeaway is it still looks like we're in a secular trend, and it still looks like the S&P could run for years, not a forecast. And it's logical in an environment where it looks like interest rates are going to be higher, or at least the bias is going to be higher in the years to come. Not only will higher interest rates potentially impact portfolio returns and the way that we structure our portfolios in the coming years, but as we've covered in detail in the past, the drivers of inflation have shifted from favoring low inflation to favoring higher inflation. Another consideration relative to retirement investing. As we've talked about numerous times in the past, interest rates impact almost everything in the world of investing and economics. While it looks like this trend is flipping, we know that markets like to overshoot, so it wouldn't be shocking, especially in the short run, if price in this instance pop back up into this area. Right now, this represents significant possible resistance, but we have to respect that this could be an overshoot scenario here. So we'll keep an open mind about how it plays out, especially in the short to intermediate term. Covered all of the concepts on your screen in detail last week. You can find that video by Googling the title on your screen here, and if need be, you can add our last name, Shavako. Thus, if we believe the present day is similar to this window here in terms of the secular trend, and similar to this window here in terms of the secular trend, then really what we're trying to do here is navigate from a point A to a point B that could be several years down the road, navigate from a point A to a point B that could be several years down the road. So it's prudent to study this window here, the blue box, and this window here, the blue box, and establish ways to monitor the health of the secular trend relative to how secular trends typically evolve over time and eventually morph into something else that's quite a bit less desirable. Thus, on this topic, we'll walk forward from here to here, and we'll walk forward from roughly here to here, which is similar to the present day. So all of these arrows are similar. So this is August of 1956 into early 1973. So let's zoom in on 1956 into early 1973. This is a monthly chart, and we're using a moving average envelope. The trend is the strongest when price is above the envelope, and the envelope, the upper and lower bands, are both rising. The trend is the strongest when price is above both bands and the bands are rising. See, this is a deterioration look here, so is this. All of this is foreshadowing the 1973 to 74 bear market that comes after this. So how would you use this? The more you look like this, the easier it is to stay with the trend, and the less you look like this, the more concerning it becomes. And you can see over time the trend weakens and eventually rolls over on the other side of this. Thus, if we believe the present day is similar to this point in here, we can monitor the present day trend by using these same monthly moving average envelopes. Thus, let's ask and answer. How does the exact same chart look in the present day? Better, worse, or about the same? Does it look like a downtrend or an uptrend? Does it look like a healthy uptrend? Does it look like an uptrend that made a stand at a logical level? The answer is yes. It looks like an uptrend. You have the healthiest state. Price is above both of the bands, and the bands are rising. And it does appear that price made a stand near a logical level. And if we look at shorter term data, it also looks favorable and is reflective of a strong uptrend. And as always, there's nothing magical about these moving average envelopes. They're simply reference points. It's easier to hold your positions when price is above the envelope and the bands are rising. Conversely, it's harder to hold them when we start to get a deteriorating look. This and this and this look quite a bit different from this and this and this, and the same can be said for this, this, and this. And like anything else, we don't want to rely on any one look or one data set, and we're always better off looking at things on multiple time frames. So this is a monthly chart. Now let's look at a weekly chart. And since the market just made a stand near a logical level relative to the trend, we might try to assume that we're trying to navigate from this low in 1958, hypothetically, to this high here in 1968. Trend makes a stand in 1962. Trend makes a stand in 1966. So same concepts. The trend is the strongest when price is above the envelope and above the upper and lower bands. The strongest portion of the secular trend is in this window here. Even though price makes a higher high here, the trend is discernibly weaker in this window and foreshadows the fact that it's about to roll over hard. This look here, similar to this look in here, just the mirror image, different perspective. This is a trend that looks like it's getting ready potentially to flip. This is a trend that looks like it's potentially getting ready to flip. But it still looks good up here. Thus, once again, if this is what a secular trend looks like, how does the exact same chart look today? Quite good. There's nothing on this chart here that says anything other than this still looks like a secular uptrend, making a stand at a very logical level near the COVID low here in 2020. Make an argument in terms of where you make the stand. It's similar to this point here in 1962. How about if we want to look at shorter time frames in terms of how we might be allocated in here relative to in here? So let's stay with a weekly but change our parameters a little bit. So we're still trying to navigate from a point A to a point B that could be several years down the road. You can see when the trend is the strongest, price is above the envelope, and the bands are both rising. Here, for the most part, and here, 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 and here. And the risks are higher when price is oscillating above and below the bands, and when the bands roll over. You can see the slope is down, slope is down. This period in here is more indecisive relative to this period here, foreshadowing this big drop. So we're the most confident when price is above the bands and they're rising. We're less confident with this look, and we're pessimistic on a shorter term time frame with this look. Price is below the envelope, and the top and bottom bands have rolled over. The slopes are now down in here. This, early in this drop, looks radically different from this, early in the rally. So if we like to think at extremes, this is the most favorable type of look here, price above the envelope. This is the least favorable look. And this is what it looks like when you switch from a downtrend to an uptrend, downtrend to an uptrend, downtrend to an uptrend. And you're still in a long-term uptrend. This is a counter-trend move. This is within the context of a longer-term uptrend. So how does the exact same chart look today? Are we in one of the more favorable periods? Or do we have a concerning look like this? We have what you would expect. It looks like over time, this is June of last year, we've evolved from a downtrend to an indecisive market to now what looks like an uptrend. This is the most favorable look here. This is March of this year. Price is above the envelope and the slope of the upper and lower band, both of them are up. This looks more like this relative to this, or this. Nothing's binary here. Lots of shades of gray. Weaker trend, indecisive mess in here, stronger trend. So in terms of guidepost, we have a monthly guidepost, one weekly guidepost, a second weekly guidepost, and now let's look at a daily chart. Very similar concepts. The most favorable look is when price is above the envelope. Upper, lower bands of the envelope are both rising in terms of their slope. Conversely, this would be your full bore bearish look. Price below, slopes down. How does this chart look today? Very similar to the previous look. More concerning, our slopes are down, price is below. This is full bore bearish in October. Now you're back to full bore bullish. Also noteworthy, we always talk in technical analysis about subtle shifts. There are some subtle shifts in the look of this chart in here relative to in here. Here, we can't hold the lower band. Here, we make a stand at the lower band. Here, we make a stand with white space between price and the bottom of the moving average envelope. That's a subtle difference, and it can foreshadow a turn. Very, very similar situation here. We have a pullback, and we hug the upper envelope. That's quite a bit different than the prior pullback, quite a bit different from this pullback, and significantly different from this pullback. Unfavorable odds over here in an oversimplified manner, mixed and indecisive odds in here, and more favorable odds over here. And all of this is reflected in our allocations and how they've morphed and how they've evolved over time. And as always, we're making comments about the charts in front of us. So in terms of the secular trend, a much more favorable look in the present day. Same can be said here, and same can be said here. Now, everything that we just covered comes from this blue box, 1956 to 1973. Remember, an uptrend is an uptrend is an uptrend. In fact, you can just look at price here. This is the strongest of the three blue boxes right here. This back here is the second strongest. This doesn't look as good as some of this, but this looks better than quite a bit of this. So as we mentioned last week, maybe you can make an argument that this box here won't be as strong as this move here, but it could be stronger than this move here. Hence, we can learn from both blue boxes. So we just ripped this blue box apart. Now let's rip this blue box apart using the same concepts. And that will allow us to develop additional guideposts relative to price action within the context of a healthy secular trend and price action within the context of a secular trend that's ending. It's a stock market peak in here. March 24th of the year 2000. The chart is 1989 to 2003. 1989 to 2000 here and 2003 here. Take it out to 2003, it allows us to discern between the healthy uptrend and the flip. The healthy uptrend into the year 2000, and then the discernible difference. This over here looks significantly different from all of this. So how does the same chart look today? Do we look like this, or do we look more like this or this? General concept is the most favorable look is when price is above the moving average envelope and the slopes of the upper and lower bands of the envelope are rising. That's what we have on June 22nd, 2023. This chart here is identical to this chart here, just different time frames. And once again, a much improved look as the trend flipped from down to up, which speaks to probabilities, and it speaks to the probability of the secular trend resuming. It speaks to the probability of the secular trend resuming. Speaks to the probability of the secular trend resuming. This is a monthly look. We can develop a weekly guidepost based on the volatility profile here in 1990. All of this in here, the uptrend, looks significantly different relative to this in here. So how does this chart look in the present day, and what can we learn from it? Looks like we made a stand at a very logical level. That's why walking forward from here, the stronger the trend becomes, the easier it is to accept that this could be the low. And there's always a tendency to think, we missed it. We missed it. Well, the rally went on for years after that. Most favorable look on June 22nd. Price above the envelope, the slopes, both of them are up. This looks more like this than this. This is early 2001 here. This is the evolution into a secular downtrend. It's not what we have over here. Is it possible that it changes? It's possible. But lately, we've been improving. The trend holds here. The fact that we hold here says the trend overall is stronger here than it was here. So we can use this as a reference point as well. Still looking at a weekly time frame here. Now we make a stand right at the envelope. And here we make a stand the lower bound of the envelope. So good reference points. And then when we come up to the peak up here, we do not make a stand. So using these parameters on the weekly chart, how do we look today? Do we look like an uptrend? We do. We look like a market that was on the ropes here, but eventually rallied, and notice how the slopes of these lines never rolled over. I got a little indecisive right here in October, a little indecisive here in December, but we never had a look like this where we flipped. And when this flips here, there's still significant downside in the stock market. And when you recapture the same moving average envelopes, the dot-com bust bear market, the bear market is OVER. We have recaptured here. This looks more like a bull market relative to a bear market. Doesn't predict anything, it just speaks to probabilities. So walking forward, we can use this as a reference point. So remember here, we said the trend here is stronger than it was here, and then we use this as a reference point. You can make the same argument in here. These pullbacks are indicative of a stronger trend. So the trend is stronger in here than it was here, and it might be helpful to have a reference point relative to the strength of this trend because it occurs within the context of a secular trend, and it occurs within a window that could be similar to the present day. So we're trying to understand this volatility profile in here, and we just use a little bit different look. This is a tighter standard. You can see we didn't hold the standard in here, held it in here, and avoided hitting the lower band here. Still a good reference point, because if you can stay above this, it's about as good as it gets relative to this reference point and this reference point back here. So we look at the same chart on June 22nd. You can see we've had some damage to our trend here. A little bit of damage to the trend here You can see here when the market bottoms after damage to the trend, at first price gets above, but the slopes of the envelope are still down. Eventually they turn. Right now we're above. You can see this looks like it's flattening out. So we'll learn something here. If this look here turns and morphs into something more like that, we'll learn something. And if it fails and we move into this area here, we'll learn something as well. The key point right now is once the market dropped below the top band in the envelope here, it could never recapture it. This is a weaker trend in here. This looks different from everything in here dating back to the spring of last year in 2022. Discernible and incremental improvement. Still has some work to do. We'd like to see this morph back into something more like this. And how concerning is it that we moved all the way down here relative to the bands or the envelope here? It does show you that the trend in here is weaker than the trend in here. However, that can occur within the context of a secular trend. Earlier in the secular trend, the trend begins here, roughly August of 1982. If we're using the same envelopes, you can see we undercut them here in 1984, and once we recaptured, good things happened. We undercut them here after the 1987 crash. We flattened out. Once we recaptured it, the low was in and good things happened. So this type of look in here and this type of look in here, which is similar to this look here, can occur within the context of a secular trend. If you have expressed interest recently, you should have an email in your email box. And that email asks you to respond to some suitability questions. And that response can trigger the next steps in the process. So from a soft opening perspective, we've started accepting new clients. And if you want to get on this list and participate in that soft opening, you can email us. This is a limited window to take on new clients. And as we mentioned last week, there's one word and one reason for doing it: opportunity. It looks like the long-term secular uptrend is in the process of reestablishing itself in a bullish manner. If you are expecting to see an email from us and you didn't get it, probably worth checking your junk folder or your spam folder. It's possible it's in there. Limited window and limited time for a single account at $500,000. You can find our email address by using this contact link on our website. Walking forward, we'll keep an eye on the economic data. 3 big shifts: inflation, interest rates, and the potential outlook for the return of balanced portfolios, a mix of stocks and bonds. If we look at the weight of the evidence, trends and stocks are still constructive on multiple time frames from relatively short to very long. And if the bias is for higher interest rates, then for the most part the bias will be for higher volatility as well. The setups that we have currently tell us that the odds that the stock market will be higher in 1 year and in 10 years have improved significantly in recent months. And that's what happens when a secular bullish trend gets back on track. Developing guideposts and trying to understand past secular bullish trends, the sole purpose there is to help us manage more effectively in the future. So for now, we'll have a longer-term focus as long as the data allows. Nothing new here. The Fed and inflation still relevant and still major wild cards. And we all know the only way any of this is going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.